Your downfall or success is 100% your responsibility, and you have to be accountable for that. Of course, some problems will scam you, and did. Trading at high level cannot be done with a single strategy.
It creates false expectations.
Start crafting your own mechanical strategy. The goal isn't really to trade your personal money.
Guys, welcome back to Risk Reward Radio. This is the show that dives inside the minds of traders and investors and gives us a peek at everything we need to know if you are planning to risk your money in order to make a living. Today, I'm joined by someone very special that has joined us here from Portugal. They have flown in especially for this podcast, and I'm looking forward to speaking with them today. If you're familiar with the content from FundedNext, their face is going to be no stranger to you. It's my pleasure to introduce Pietro. How are you, my friend?
Thanks. How are you?
I'm very good. Thank you. How was your journey in?
Smooth so far.
You mentioned you've been hating the cold of London already.
Yeah, I'm not used to 4 degrees plain day, so yeah, but I'm adapting.
Yeah, fair. Pietro, I think it probably just makes sense. For anyone that is maybe unfamiliar with you, would you mind giving us a little bit of an introduction into your journey into trading and how you got to be where you are today?
Sure. So yeah, I'm Pietro again. I'm 21 years old this year, turning 22 soon. And I started trading close to 4 years ago. I was still in school when I started trading. And yeah, it's been quite a ride. The first kind of place where I approached trading was actually a Signal group. And I joined that because they gave you like a free course with that. And I wanted to actually learn how to trade. And that was the first place that I saw trading related. So I joined that and I left a week after.
Okay.
Yeah, because it was terrible.
Yeah.
Yeah, not just the signals, but the course too.
Okay.
So, and from then I started like my journey, my educational journey in trading.
Yeah.
And I've studied pretty much everywhere that was advertised during those years. At first in Italian, like the first few months, but then immediately I jumped straight to English language and the English communities and stuff. It took me quite a lot of months, years, to really understand the nature of this job and the nature of this business.
Yeah.
Like the job as a trader and the business of trading. And but now, yeah, I can finally say I live off of trading. I've been living off of trading for quite a few months. I moved from Italy to Portugal alone. And yeah, things are going good, and hopefully they're going to be great.
Amazing. So it's really interesting to get inside the mind of somebody so young in this business, because 21, I mean, for me, I feel like you're a child in my eyes. But it's interesting. How have you found the transition? So I'm guessing, are you finished studies in school now? Is that right?
Yeah, I finished high school, yeah.
Okay. And you're planning to stay in trading full time?
I currently am a full-time trader, and I'm planning to stay because I love the job.
Yeah.
Yeah.
What really attracts you to it? What do you like about trading?
The fact that your downfall or success is 100% your responsibility, and you have to be accountable for that. And trading is the ultimate accountability job.
Yeah.
Where if you do bad, extremely bad, it's entirely your fault. You can't blame it on conditions or whatever.
Yeah.
But it's that way also if you do good. So yeah, that's what attracts me. That's what I like most about trading. Plus, of course, the potential of the scalability of the business.
Yeah.
So I think, in theory, like on paper, there's nothing that theoretically could pay more than trading if done correctly.
Yeah. I like the fact that you touch on accountability, because I think it plays a massive role in trading. I know it did for me. It's interesting, obviously, hearing it from somebody else as well. But I think it's also the thing which holds a lot of people back. It's also the thing, like, it's so easy as a trader to blame someone else or something else for the reason why you haven't found the success that you're looking for, or maybe found the success that you're looking for. And, you know, it's the accountability part, which really, it's a hurdle for a lot of people. I think a lot of people struggle to look in the mirror and say, it's my fault, or I was responsible for making that right or wrong decision. And it's something that's very easy to shy away from. And I see this a lot online these days. I find a lot of people are so quick to blame prop firms and brokers and somebody scamming them or something. And ultimately, the most difficult thing to do is just to take accountability and responsibility for yourself, focus on what you can control and move forward from there. Would you agree?
Yeah, I agree, definitely. But also, yeah, so every trader, when developing the skill, has to be, like, if it's a serious person that actually is wanting to take this as a job, has to always think in the worst case scenario. So for example, yeah, you mentioned prop firms. Of course, some prop firms will scam you and did, but like for me personally, when I buy a challenge or when I buy a challenge or whatever, like whatever challenge I take up on, I immediately consider that as a loss. So like when you enter a trade, I'm not imagining how much money I'm gonna make. You know, I have that planned before, and yeah, if it, like I'm already considering it as a stop loss. You know, that's my cost to enter the trade. Maybe I will recover that if it goes to take profit. So I think that's kind of a mentality shift that from a normal person that doesn't do trading has to do, because yeah, if you think about it, every trader, like, in order to be successful and not go crazy, has to always think in terms of worst case scenario.
Yeah.
And of course, maybe it's not your fault if somebody scammed you, but you can't let that stop you, because you should have taken that like into account beforehand.
Yeah, 100% agree. I think that's quite a unique mentality in the sense that not a lot of people think that way. I think more people come into trading and only focus on how much money they could or want to make. And that a lot of it is to do with their downfall, right? It creates false expectations. And I've always found, again, at least from my experience, that the true success of a trader is really determined by how they can take a losing trade, right? Because I find the ones that don't take it very well, they are the ones that will typically struggle. It can be easy to take a winning trade, right? You don't actually have to be skilled to take a winning trade on your next go. You just have to be a little bit lucky. But to be able to consistently do that, and for me, more importantly, bounce back from the losses, is often the more difficult skill to master, which is why I think I focus so much on the psychology side of trading. So yeah, it's an interesting perspective. Was that something that you had right from the beginning, or is that something that you had to learn and develop?
So actually, when I first approached trading, I thought I would crush it, because being that, like, okay, that's from my past. I won some competitions in maths and statistics before I started training. So okay. I was a little bit cocky, you could say, and I thought this would be just like, it's my bread and butter. I can just take over and make it my job in a few months.
Yeah.
But yeah, then reality kicks in. It hits you, and you realize nothing of that, about nothing, like your skill, your previous skill set, those don't count. It doesn't matter how good you in math or statistics you are. Of course, maybe you have a predisposition. If you have a predisposition for statistics, it helps when doing research. Also, that's quite an undervalued an undervalued part of trading, the research part. Yeah, but we'll touch upon that later.
Yeah.
And I had to develop this mentality, because again, I was very cocky when I started, and the market was very quick to humble me.
Yeah. I think especially because I think you mentioned earlier, you've been trading around 4 years. So that kind of puts you in and around the time of COVID. And I know obviously firsthand the havoc that wreaks on the markets in terms of volatility and trading conditions. And so it's a really interesting time to start. I would love to know a little bit more about your strategy and approach to the markets, because for me, finding someone that has actually found their feet in the markets as quickly as you have, and especially as young as you have, is quite a rare thing. Would you mind sharing a little bit about your approach or strategy? Because I know I've obviously seen a little bit of your content online. I know you talk about things like volume and things like that, how you approach the markets. Do you mind giving us a little bit of an insight on that?
Yeah, sure. So online, I talk about pretty much not every topic, but most of the topics, because it doesn't really matter what you trade. What matters is the approach. So when you understand that your job as a trader is not to marry a strategy and expect your returns through the year, you understand that you have to do a kind of different job beforehand. So what's the approach I'm talking about? Everything that you do in the markets, when you press a button, when you do the analysis beforehand, can be metricized. So whether it's your stop loss placement, whether it's like the entry or the confirmation you look for, those can and have to be metricized in order for you to be a positioned trader. I'm not talking about position like swing positions and stuff. A positioned trader is a trader that knows his metrics, and everything that he does is metricized. So when you are a position trader, you know what to expect in the markets as a performance when you're overperforming and when you're not overperforming. So when you're down performing or performing like average. So whatever type of trader you are, it doesn't matter what you are doing, but you could be classified in two ways. You're either a margin trader or a scaling trader. Every trader trades a specific, or tries to trade knowingly or unknowingly, a specific inefficiency, a specific market inefficiency. It could be performance inefficiency, liquidity inefficiency, whatever. And those inefficiencies in the markets tend to close and to mitigate themselves in cycles. Everything is through cycles in the markets, whether short cycles or long cycles. So whatever type of trader you are trading an inefficiency. What matters is long term, your inefficiency is going to be mitigated, and if you still are trading that inefficiency, you're not going to be trading ideal conditions, ideal market conditions for your strategy. So it's important for a trader to understand that you are not your strategy. You are a trader, and your job is to create strategies, metricize them as good as you can, and to be a position trader for you to take advantage of the market inefficiencies that you're trying to trade in a specific moment in time. Could be for a few months, could be for, I don't know, market is in cycles, long cycles, short cycles. And again, I got kind of lost. So, okay, you can be either a margin trader or a scaling trader. Me personally, I'm a scaling trader. And the difference is basically the risk to reward that you're taking. For example, a margin trader is a trader that takes one risk to rewards. And long term, when the inefficiency that he's trading is mitigated, is closed, the graph of his equity curve should look something like a consolidation in like a consolidation. So it shouldn't look like this. Okay. It won't look like this. Okay. If you're constantly trading your strategy as a margin trader through the years without adapting to the inefficiencies.
So is that meaning they're unprofitable? Is that right?
It's not unprofitable. It's just, again, there's not an unprofitable strategy or a profitable strategy. When you metricize a strategy, you know what to expect in when the inefficiency that you're trying to trade is present in the markets.
Okay.
So that's why trading at the high levels at hedge funds, or not necessarily in hedge funds, but trading at high level cannot be done with a single strategy. There's no hedge fund that trades with a single trader with a single strategy. Why is that? Because the optimal way to manage a portfolio is to have margin, scaling, and maintenance of the scaling together. That's a mathematical equation that with a single strategy, you can't have all three of them together. Because if you do scaling, you can't do margin, and vice versa. And if you do scaling, you need maintenance. And nobody talks about that on the internet. I got taught all of this by my mentor. And it's a pity because there's a lot of people that teach on the internet, but these are the best things that you could that attracted me to trading in the latest period. And I wish there was more communication about this side of trading that is unknown to most traders.
Yeah.
That was unknown to me until a few months ago. So yeah, basically this is my approach. Yeah.
Interesting. Do you mind explaining a little bit more on the scaling approach? Because you said that was more your style, right?
Yeah.
You weren't the margin trader, you're the scaling trader.
Exactly.
So what's it like on that side?
Yeah. So you're scaling when your risk to reward is not 1. So
Okay.
my risk to reward is varies from 2 to 8, but I know how to take. I did take, like, my last trade was a 10 risk to reward, but that doesn't matter because that doesn't matter. So a scaling trader is somebody that takes risk to rewards, not 1-to-1s, but like 1-to-2s, 1-to-3s, whatever.
Okay.
And in a strategic portfolio management, you don't want it. Does like I will connect myself to the topic we were touching on before. So people don't have the right expectations. Why? Because people don't know that for an investor, it doesn't matter how much you make through a year. He looks at how much debt you're making throughout the year. So of course you can say to me, yeah, I've done 1,000% this year. Okay, but how much debt did you make on that 1,000% drawdown? That's what investors don't want to see, drawdown. And eventually, if you're trading a specific inefficiency and you're overperforming, you are maturing debt that you will have to how do you say that?
Like pay back?
You will pay back
right.
on the markets.
Yeah.
Eventually.
Okay.
So that's why at top level the asset management is done with margin and scaling, with maintenance all together. So there's there are phases, there are cycles of performance cycles with objectives that have to be reached, and then you move on to the next cycle. So for example, let's say we have 3 investors that they are very conservative investors. They don't want to experience drawdown, as of course any investors would like to experience the least drawdown they could. Okay, and we with trading, our objective is to make, let's say, we can tell them around 10% to 15% a year, but it doesn't really matter the performance you make. What matters is the drawdown that you mature. So the first phase would be to create some margin for the scaling trader to kick in. So for example, let's walk through a cycle. Margin strategy is, and I'm now separating them, but they're never separated. So margin trader keeps trading throughout the whole year. The scaling trader keeps trading throughout the whole year, but just with different risk management. So when there's the margin phase, the account has to build a margin for the trader that does scaling to do the scaling. So to win the cycle. Okay, so I'll walk you through a rudimental management of a portfolio. For example, we have $10 million. Okay, we want to make every trading cycle that is not bound to time, is bound to performance. We want to make 1%, 1.5%. Okay, so the margin trader has to risk, I don't know, let's say 0.1%. He has an objective. He has to reach 0.3% or 0.5% of the as a target. Okay, let's say 0.3%. Okay, when he reaches that, his phase is complete successfully. If he doesn't reach that, it's failed, and that's the only part when you fail a cycle and you go into debt. You go into drawdown when the margin trader fails. The margin phase fails. Then the scaling kicks in. The scaling trader kicks in and starts to trade off the margin that the margin trader created.
Right.
Okay, so if the scaling trader fails and burns the margin, okay, it's still a failed cycle, even though you, with this management, even though you don't make debt, but you lose time.
Right.
Yeah. So it's still a failed cycle. But again, you only lose money when the margin trader loses his cycle.
Right.
Okay. But let's say now the scaling trader does That's good. That's a complete cycle. And the scaling trader with the scaling strategies, so with higher risk to reward, reaches the 1% or the 1.5%, whatever. Okay, that's a good cycle. Throughout the year, you can expect to make many cycles throughout every month. And okay, but not every cycle would be successful. So you will have, for example, I don't know, let's say two successful cycles, so where the scaling phase is done correctly and it's in profit. But maybe the next cycle will be an unsuccessful cycle where the margin trader fucks up, okay, and you go back a little bit. But the most important part is you lose time.
Yeah.
So, but with this specific approach, very rudimentally explained, you don't create much debt.
Yeah.
So throughout the whole year, it could be good. You could make 10%, 20, 30% with this conservative approach.
Yeah.
You can't make 60%. I mean, you can, but it's unlikely.
Yeah.
You can't promise to play around the 60 to 80% return in a year. Why? Because it's very conservative. But of course, there are also more aggressive investors and stuff. The major hedge funds do a lot of that. This is kind of a lower league from the league that hedge funds play in because of the approach and of course because of the money that you can gather with this type of management. But yeah, not many. I always make references to football because it's very, it fits very well with trading. I think in the beginning stages of a trader, he doesn't really know what margin scaling means, so he's trying to do both of them unknowingly because he doesn't know, as I didn't know in the beginning. It's like playing in your little town when you do the goalkeeper when you need, and also you do the defending, and you're a striker from time to time. Yeah, but when eventually you're good and you like the game, and you keep playing, you have to be when you go to top levels, you have to be vertical about your position. So I'm a scaling trader. I may be a margin trader if I was that kind of trader. Okay. At the top levels, players are recognized with how vertical they are in their position. So yeah, that's how it really works, like at the top level, management wise. And I think that's the goal that a trader should have. Like, the goal isn't really to trade your personal money, because I mean, you can do that, but it's you're trading your personal money. I mean, trading was always about managing big funds, big capital, others' capital. And I don't know why, but I feel through social media, people lost that kind of ambition. I don't know why. They now think, okay, prop firms are a tool to then get to trade my personal account. Yeah, but the trader is, the real trader is somebody that manages big capital and others' capital.
I think I really like this idea, by the way. I've never heard it phrased in the way of margin and scaling, in terms of how you go about managing risk, especially for a much bigger fund. But the concept makes complete sense to me. And I like the idea that it's focused on obviously minimizing drawdown. To come back to your later point on why traders are, I would say, pushing to focus on their own capital. And I can tell you, based on the experiences I have with traders, I think that nowadays there's a big push for people to want to be independent and free, and to be in a position where you can make money from the markets without having a boss, clients, expectations, external targets that you have to live up to and report to. I think that level of freedom is attractive for some people. But again, it's not for everyone, right? And I think the important part is knowing, I guess, what your end goal is. And it's interesting to hear you talking about this, because I know when I was 21, I wasn't thinking about any of this stuff, right? I had no idea where I wanted to be or what I wanted to do. I knew I wanted to be successful. I knew I was ambitious, but I had no idea how to connect the dots to get to the very end. And I still don't think I'm there, but I've definitely been someone that's kind of just worked it out along the way. So it's interesting because you seem to have a very clear roadmap of the direction that you want to head in at quite a young age. Would that be correct?
Yeah, it is.
Yeah. So where do you see, if you don't mind me asking, where do you see yourself in 5-10 years? Where would you like to be what sort of position would you want to be in as a trader?
In 5 to 10 years. Yeah, I haven't really thought about that, but probably in a high position on my own or my team's hedge fund.
Okay.
Because I really like the top level of trading. Yeah, where you don't have to, like, where all figures, all parts of trading are separated. So for example, we are really used to being traders and having learned alone, probably, as most people do these days. We are used to being the trader, the analyst, the researcher, and the risk manager, where it doesn't really need to be like that. So for example, we can do all those parts together. For example, I enjoy doing research a lot. I'm doing research with my mentor, like very vertical about that. And like that's the most beautiful part of trading for myself. But yeah, there's the trading part, so the execution part.
Yeah.
There's the analytical part, so creating the scenario with fundamentals. Fundamentals is, I don't mean just market news, but every type of data that is not graphic data is fundamental. So for example, option expiration dates, everything that's not graphical. Then there's the risk management part, of course, not just the selecting how many lots you put in, but like designing the whole plan of risk management. So for example, something that looks like the stuff that I explained to you earlier.
Yeah.
And the research is very important for you to keep growing as a trader and for you to keep having more and more tools and more developed tools to create your strategy and your management. Yeah.
I like that because I think the notion that I always, as I mentioned to you before, I'm big on psychology. And everything that I teach people about the mindset side of trading is a lot about moving them away from having this need or desire to predict the market, because I think this is quite detrimental for a lot of people. When you fall into this idea that your job as a trader is to predict what's going to happen next, the times where that doesn't happen, and that's inevitable, you're always going to be disappointed. You're always going to feel like, I haven't done my job right. I need to correct something, or I need to learn more, or I need to do something different in order to make sure that I don't mess it up next time. But the approach that you share, I think I phrase it very differently in my mind in how I communicate it, but I think we're trying to achieve the same thing, which is the trader is ultimately, the most important job is just managing risk. And if you can put yourself in a position where you're focusing on minimizing drawdown and maximizing the upside in certain positions, whatever strategic way you try and do that, whether it's margin or scaling, whether you have a different approach that seems to work for you, being the risk manager psychologically, I think is much easier, because the risk manager's job is not to avoid losses, it's to minimize them. And that's a very different mindset. It makes it very easy to accept losses, accept periods of drawdown, accept periods of underperformance, and understand that the markets are not always going to be a rational place and you can always predict what's going to happen next. So I like that. It makes a lot of sense to me. And it's something that I can relate to a lot. So yeah, it's really, really interesting.
Yeah, sorry. So I think that most people, if they just did proper risk management, and I'm speaking from my point of, I've done that mistake before. Just with proper risk management, you can't burn an account. Like, it's impossible. It's very hard. Otherwise, if you are able to burn an account by risking 0.5% a trade, hit me up. I will reverse trade you, because man,
it's a great strategy.
It's impossible, man. So just with proper risk management, you should be able to float around break even.
Yeah.
Or have minimum drawdown.
Yeah.
So just with risk management, proper risk management alone, you shouldn't burn accounts.
Yeah.
Then on top of that, if you build the research part and you become a good analyst and a good trader, so the execution part, then you really know where you have to work. Because maybe you are not really sure about the inefficiency you're trying to trade. Maybe you're not even positioned, so you really are kind of trading every kind of setup, every kind of trade. So you don't really know what you're looking for. But that always comes from a place of inexperience. So if you don't do your research and if you don't metricize whatever you see in the markets of course you can't know if whether you are positioned or not. Of course you can't know if you're doing things correctly or not. So you mentioned earlier, your job as a trader is of a risk manager. Yes, and your job as a trader is to stay in your position. So are you a position trader? Do you know what you're looking for? Yes. Stay on your lane. Do that, and the results will come whether the inefficiency that you're trying to trade is playing out or not. But it's impossible to burn an account because of that if you're positioned and if you do risk management.
Yeah, I like that. I want to pivot into a little bit of the research side. I know this is obviously something that you're passionate, you know a lot about, you spend a lot of time on, and you mentioned you had a math and statistics sort of background.
Yeah.
So talk to me a little bit about this. For the trader that is maybe uninformed in this area, what does doing the right level of research look like to them? What should they be doing or what shouldn't they be doing? And how can they improve on this side? And what impact will it have for them?
All right. So the most common confluence that every trader trades these days is market structure. So let's take that as an example. Okay. How do you classify market structure? Most people just do it like this, like very discretionally. And of course, it changes from day to day, or maybe depending on your mood, maybe depending on whatever happened to you in life. So that's not a very professional way to trade. Okay, so when you want to metricize something, you have to do your research on it. So for example, let's metricize structure. Okay, I trade market structure. How do I metricize that? Well, the question you should ask yourself is, how do you want to take market structure? Okay, let's say eventually, if you do a study and you do research on one of your metrics, you will classify it. So for example, okay, let's classify market structure. There will be probably a main structure and there will be types of substructures. Okay. And they will probably be interconnected with them, like between each other. Okay. So how are they interconnected with each other? That's the part that you have to figure out doing research. How? There are two types of approaches that you can take. There's the empirical approach and the scientific approach. So everything that you're trying to trade in the markets should be either with an empirical approach, or meaning statistical. Okay, it happened this and this and this, these and these times. Okay, it's empirical. I have this happens 60% of the time. I observe that this happens 40% of the time. I put them together and I see what happens. Or a scientific approach. So I know when a level of optionality gets taken in the market, gets reached, I get a reaction. That's scientific. It's not, of course, it'll have empirical, you will see it empirically because it happens, but it comes from a different approach. Scientific approach means I'm trying to discover what happens in the market really. So, and I'm not saying scientific approach is better than empirical. I've traded with empirical approach for most years of my life, and it's really no different. Like, you can be profitable with both. Doesn't matter. The difference is, again, the approach, because even empirically you will see many things that play out most of the times. Why? Because there are scientific truths of how the market works, and it goes both ways. Scientifically, you will see that every concept that it's scientific in the markets has his empirical reflex. You will see it happen in the market statistically. So the difference between these is the approach. And again, it's not that one is better than the other, but you should have that in mind before trying to build your strategy. So again, when you're doing research, okay, market structure. While am I trying to metricize my market structure? Am I trying to do that with an empirical approach or with a scientific approach? So then the question you should ask yourself is, do you know how the market works?
Yeah.
Most cases, probably not. If somebody hasn't taught you that beforehand, because by ourselves it's very difficult. It would take a lot of years, but again, you can't know how the market works if you don't speak with the people that move the market. Okay, so let's say, okay, you want to metricize the structure in an empirical way. All right. So now you have your main structure, your, let's say, primary substructure and secondary substructure. Are they tied to a specific time frame? this you have to specify too. Okay, you don't have one type. You'll find out you don't have one type of main structure. You'll have, depending on your trading objective, what you are trying to trade. Let's say you're a day trader. Okay, so you're trading in sessionality between sessions. Okay, you will have your main structure on a sessional level, and then you'll have your substructures. Okay, that will be different for a trader that does like intra-weekly trading, and he will have like his main structure and his substructures. Probably his secondary substructure is your main structure as a day trader. So those are all kind of things that you have to figure out in your research, and the more vertical you are about that, the more your studies will be developed, deep, and the better your strategy will become. Because imagine you do your research with about structure, about, I don't know, cycles, both daily, weekly, and stagionality, whatever.
Yeah.
And you do your research and metricize whatever you see in the markets. That's the right way to approach trading, because that's the way you learn more, and that's the way you have to develop as a trader. You won't develop by just executing and trying to better your performance without doing the research that you need to be doing.
Yeah.
So yeah, that's how I do research with my mentor.
I like that. I also, again, taking it back to the psychology side, which is my niche, is my passion. I have a big emphasis on traders needing, I call it data. You call it research, I call it data, right? You have to understand how your approach actually works in the market, how often it works in the market. And I think the biggest part behind that is it gives you confidence in your approach. And I think confidence is a massive factor. It impacts how you execute, how you can hold, how consistent you will be over time. And without that level of confidence, it's very easy to become emotionally driven and moving away from your specific approach in the markets to just operating on emotions and impulses, especially when things don't go your way. So I think, again, my perception is I call it data. But yeah, I think research is massively important to everyone and everything that we do as traders. How much research or data would you say someone needs before they can say, I have an approach that works?
Okay, you're talking about data, backtesting data of a certain strategy or metric?
Maybe both.
Okay, so the way I approach trading now is not, I don't backtest a strategy.
Okay.
So I have my metrics that I am developing and that I already developed, and I study those, and I know it's like cooking. Okay, so those are my ingredients, and I kind of have to find out which ingredients work best together, and then it's inevitable. You will be profitable, because if you do your research properly and your metrics are good and defined, and you're very vertical about them, and you know what, like you divide whatever the market can do in your metrics. Okay, then you know in which phases certain metrics are going to be best with other metrics, and you have to develop your strategy around that. When developing, so how does it work? You start developing a metric by asking yourself a question. So for example, the structure one. Okay, does the market have structure? Yes, okay. But most of the time, many times, not most of the times, when asking yourself a question and developing and doing the research, you will find yourself, you will find out that you were asking yourself the wrong question. So by developing that metric, you will develop your studies and end up with another question. Or you will end up just with discarding your metric. If you discard it, you don't use it. If you don't discard it, it's good. If it's good, it's impossible that you're not, it's possible that you're not profitable, but it's impossible that you just go bonkers and you just burn accounts, okay? So it's not about how much, okay, if you backtest, if you do your studies in an empirical way, I would say when day trading, you like below 6 months, you can't do anything. You have to at least 6 months. Plus, if you're a day trader, you probably use the M1. So with the premium option of TradingView, you have access to 6 months, even a little more with a trick with the backtesting tool that they didn't fix. Last time I used it, but whatever.
Yeah.
So at least that. But then it gets easier if you don't trade a 1 minute. So if you don't trade a 1 minute, let's say you trade a 5 minute, you have access to many more months. So at least 6 months. But yeah, again, the best way would be to know how to code.
Yeah.
And to do that, your studies through softwares, like studies, not just backtesting the strategy and the execution part, just the studies.
Yeah.
For example, through strategy quant or whatever, doesn't really matter. If you know how to code in MQL 4 or 5, if you know how to code in Python or C#, whatever,
Wait for this to pass. Yeah.
Does it here? Oh shit!
Welcome to London.
Yeah, yeah. Lisbon is no different. Like all day long. Yeah. Yeah, I don't remember where we were.
We're talking about, you mentioned coding.
Yeah, about coding. The best way to do your research, in my opinion, is through coding because it's more efficient. Of course, if you have your data feed, you coded the metric that you're trying to do research on, and you run it through strategy quant or whatever you want to use, and you develop your studies through that. It's far easier than, of course, how to code. You have to know how to code, and you have to do it correctly. So you have to check when you wrote the code that it actually reflects what you were trying to do. That's the hard part. But then if you manage to do that, the backtesting is very quick. Otherwise, if you don't want to learn how to code, which I don't recommend if you go into this kind of approach, you can do it manually. I did it manually for a lot of months. I was before I started with this approach, I was backtesting in a single day 3 to 6 months of a strategy with M1, M15, and H1 data. That's a lot of hours and chart work. You burn your eyes, you fry your brain, but yeah, I did that, and of course, I got some good results. But yeah, again, I was backtesting this strategy, which I don't think anymore it's the best way to do your research.
Okay.
Yeah.
Interesting. Am I right in presuming then, if you have a very research-based approach and you like to have metrics behind everything that you do, a lot of your approach then, would you consider it quite mechanical? Or is it possible to have research and metrics based approach, but also be quite discretionary?
Okay, so the thing is, they're called all-season systems, so expert advisors, bots. They don't work. If they do work, you wouldn't sell them, you wouldn't advertise them, because
make it for yourself.
Let's say I have an old season bot, so one that is just written and just runs, that is profitable. If I give that to the world, it's not going to perform anymore, right? So you could say that this is a mechanical approach, yes, but in what regard? It's mechanical because the discretional part is to put the positioning of the strategy. So for example, let's say I have 3 systems.
Yeah.
One that does the margin phase, one that does the scaling, and another one that does the maintenance on the scaling part. Okay, my job, these are systems, so they are mechanical. My job as a trader is to position them correctly with thinking about cycles, so performance cycles. And that's the discretional part. So yes, mine is a mechanical approach, the research part.
Yeah.
But personally, it doesn't have to be. I like it more that way. But the discretional part is still a big factor when positioning your strategies. Yeah.
Very interesting. Very interesting. I like that. I think it makes a lot of sense. And I think a lot of people get caught up on the idea of, do I have to be 100% mechanical? From my perspective, I've always said that I think it's easier to find profitability if you have a mechanical edge or strategy in the market, because you have research. You can prove it works. Whereas people that rely on just discretion and experience and gut feelings, it's very hard to test that. It's very hard to test that that's going to work the same way, because your perception of an event today could be completely different if you look back on 6 months. And so, yeah, I've always said I think it makes more sense to have your edge or your approach in the market backed by data and research and metrics. And if you think that applying discretion works better on top, then actually track this going forward and prove it to yourself,
Exactly.
right? Have a journal, have data, build that from live testing that actually shows you that your discretionary input actually has a positive benefit to your mechanical edge. And that should be the only reason you stray from it. Otherwise, you're trading more because you want to be right rather than actually wanting to make money, which is hopefully the reason most of us are in this game.
Yeah, exactly. I have to talk about this. So the first payout that I did in trading was with my first mechanical strategy. So that's my biggest advice for any trader that is struggling right now is start crafting your own mechanical strategy. Why is that? You will find that when you first devise your plan, you think you got it, you think you made a mechanical, you will start doing your backtest. That's mandatory. You can't start trading a mechanical strategy without having backtested it.
Yeah.
Why? Because backtesting data with a truly mechanical strategy is as good as live test data in terms of quality. Why? Because there's no discretion involved. So it doesn't matter if it happened yesterday or if it happens tomorrow. Same quality of data. Okay, when devising your plan and doing your backtest, you will 100% see that some of your points of your checklist are not exhausted to the dot. Why? Because you never did it before. Okay, so you will have to specify. For example, let's take structure again. Okay, you have written how you take structure. Okay, and you will find some exceptions where that rule doesn't exhaust. You don't have one way to draw structure in some exceptions. Okay, you have to exhaust every one of those exceptions that you encounter in a period of at least 6 months of backtest. Okay, when you've done at least 6 months of the backtest as a trader, and you've written every rule and you've exhausted every scenario that you've encountered with your checklist, you can then start trading live, and you don't even need to go demo because it's no difference. You can go trading live directly, and you will see that psychology magically shouldn't be an issue for 90% of traders. Why? Because you have your mechanical plan and you've done your research, you've gathered your data, you know that it was profitable. If it wasn't profitable, you wouldn't be trading it. So, and it's hard to find a mechanical strategy that works because it's like devising an old system, an old season bot. It's like it's like writing an old season bot. They're very hard, like it's almost impossible to do them. But let's say you find that in the last 6 months something worked good and it was profitable every month. Very difficult to do. But let's say you find it out and you figured it out. You start trading that. And that's why is that the best tip that I could give a beginner trader or a struggling trader? Because all that part of devising the plan and all that part of exhausting every point of your checklist, nobody does that, or very few people. That was my step up. That was my when I leveled up in trading. And you will see, okay, probably you will have some psychology issues afterwards, but they will be different. Yeah. Beforehand, everything that you do wrong, you blame it on psychology or you blame it on something else. That's a childish way if you haven't done your research, a childish way to complain. After that step, you will know that you will see that the psychology issues that you encounter will be probably different. But they are better problems to beat, to solve. And you will always have problems in whatever business, not just trading. But as long as you progress, you will have better and better problems to solve, and they will be more enjoyable to solve.
I feel like I can attest to that because I'm in a very fortunate position. I always say that I get to speak to probably hundreds of traders a month. The vast majority of them are not making money. There's only a very small proportion of traders that are actually successful, and the statistics support that, right? But the traders that I work with that are aspiring to be profitable, they usually have like a basket of fundamental problems when it comes to psychology or their strategy. And I think half of the issue is a lot of traders don't truly know what their problem is. As you said, some traders will blame their issue on psychology when they don't really have an approach that actually makes money over time. And then a lot of traders will say that the issue is their strategy, but it's actually their psychology. They're not being consistent. They might have a plan. They might have a mechanical set of rules. They might have all the metrics in the world, but they don't have an ability to be consistent and actually execute on it.
Yeah.
And as a trader, if you don't have that ability and you're actually putting the trades on yourself, you haven't just coded them to run themselves, then that's a really important part of the game. And that's where I feel like the missing part that backtesting or research or metricizing all of your approach doesn't give you is actually managing money for a living, right? Because I presume obviously in your approach, and I think we're going to fall out if you're going to say this doesn't happen, everyone takes losses, right?
Of course.
Of course, right? Everyone takes losses. There are some people that are delusional to think that it's never going to happen, but everyone takes them. And it's in that moment, it's like, how do you deal with being wrong? How do you deal with working really hard at something, putting hours into your craft and a lot of energy into your craft, and then the result is not just that you're wrong, but you've also lost a bunch of money as well. That psychologically for a lot of people is so destructive that they go on tilt for the rest of the day, the rest of the week, whatever trading period you're looking at. And that's usually what causes a lot of issues outside of having the right foundation. So it makes a lot of sense to me.
Yeah, and of course, those people, their mistake is to think that you could be right or wrong in the markets. There's no such thing. There's no thing such as. So, for example, okay, you have a strategy and you know you are trying to trade a certain inefficiency. Okay, when that inefficiency doesn't present in the markets, of course you are going to experience drawdown. When that inefficiency is going to be present in the market for an extended period of time, you're going to be overperforming. What's overperformance? Basically, like if you trade with leverage, you're technically overperforming. So like if euro dollar does 0.1% and you're doing 10%, that's technically overperformance, but that's another story. So when your inefficiency plays out and is present in the market for an extended period of time, you are overperforming in that. And it's physiological that sooner or later you will experience drawdown. When that inefficiency isn't present in the markets. It's not about being wrong or right in the markets. Like there's no such thing like this. Yeah.
I like that. I like that way of thinking about things. There's something I want to pivot onto that I think will be an interesting line of discussion, especially given at your age as well. And I don't mean that in a bad way. I hope that doesn't come across that way.
No worries.
So something that I found very early on when I was younger was that when I went from having a 9-to-5 job to then working for myself, whether that was trading, whether that was running my coaching business, whatever it may have been, having that level of freedom of time was quite interesting, right? So not being bound by the normal 9-to-5 constraints of a normal job and having that structure can be either very beneficial for some people or very detrimental, not having the rules and the routines and things like this. So obviously I know that you are a full-time trader now and that gives you a lot of freedom of time. I know that you also create content for FundedNext. What does an average day look like for you? Is there a set routine that you have with your days that you follow? Because like I said, I think having all the freedom to control your own time can either be completely wasted for some people or can be super, super productive. And for me, I had to learn how to instill structure into my life. Have you found that you've had a similar battle or anything that you've experienced that you can share?
Definitely, yeah. So I always say in many of my videos for FundedNext, I always say, keep yourself busy. What does that mean? If you have nothing to do throughout the whole day, probably at some point in your journey, you are going to be trading the whole day and you will experience for yourself, that's detrimental. Yeah, that's not trading. That's a full-time job.
Yeah.
Okay, of course. I also say, okay, you wanted to escape the 9-to-5 and you will probably in the first years find out that this is a 12-to-7, but not execution-wise. It's not that you're not executing trades 12 hours a day, 7 days a week, 5 days a week for Forex. But it's the research part, the devising the plan part, the learning part. That's where you have to put your hours, all waking hours in the first stage of your career, trading career. But yeah, coming back to the routine, yeah, right now I'm stressing the point right now because it's not definitive.
Yeah.
I'm waking up so I'm same at London time. I'm waking up at 6:30. I am by the chart at 7 Frankfurt session, and I trade. I wait. So you know how trading is by this point. So I trade on an average day 1.5 hours. So half an hour past London Open. But it happens that I stay on the charts a little longer. If I don't take anything, or I'm expecting my setup to be present in New York session, I wait for New York session. It's very rare, but sometimes it happens. And right now, currently, I have lunch after London session, and I head over to the office, to my mentor's office, where we do research and we prepare and we work on things. And I come back home at dinner time. Past dinner time, I have dinner and I go to sleep.
I find this always such an interesting question to ask people, because I'll give you an example. I think it was 2 or 3 weeks ago, I was speaking to a trader that basically was describing that they don't have any patience. They said, I know exactly what I'm looking for. I've done tons of back testing and I've got loads of data, but I can't help but get into a position when I'm looking at the charts. And my response, firstly, my question was, what's your plan on dealing with boredom? What do you do when there's no setup? When you're waiting for a setup to present, how do you react, or what do you do? What do you work on? What hobbies do you have? And they didn't have a plan. And I was like, well, that's, I think, a problem in itself. And that's probably something that you need to fix. And I think the interesting line of question that I went down with them is, I asked them, why did you get into trading? And they said, I want more money and I want freedom. And I was like, okay, freedom to do what? And they were like, well, I want to play with my kids. I want to have control of my own time. And I was like, the ironic thing is, when you don't have a setup in the market and there's nothing to do, that is the market's giving you freedom. That's your opportunity to go out and do something that you like, or work on a different aspect of trading. But it doesn't mean that you have to create an opportunity in the market which maybe doesn't exist, and then you end up underperforming your own edge. And they kind of stepped back from that conversation. They were like, that's an interesting way to look at it. Like, I've never thought of it in terms of the market's already giving me what I want and I'm just choosing not to use it. So yeah, it's super, super interesting. And I like that you've created some structure for your day. What is your long-term goal with trading? Like, I know you're obviously quite passionate about this. You've mentioned already that you plan to stay in this industry for at least the foreseeable future, if not indefinitely. Do you have an end goal, whether that's maybe an amount of money or a certain position or capital under management? Is there a goal that you're working towards?
Currently, I'm just working towards a goal that isn't set, so towards the finish line, but I don't know what's the finish line. So maybe that should be my answer, but I think, so it could go 2 ways. Either I keep trading and I keep getting better and better at trading, and I gather capital with my mentor and other analysts, and we trade on that capital, and it's good capital, and we keep trading and everybody lives a happy life and whatever. Or it could be the other way. For some traders, some institutional traders, it went that way, that you start trading with bad capital and you have to disappear from the world, So my goal is to stay in the first, with the first option. That's my main goal. As long as you're working everything with like clean, asset managers, certified, that's my goal, to keep working clean.
Nice.
I don't have a number in mind.
Okay, yeah, I like it. There was an interesting quote that I came across, and I think it comes from the book, The Psychology of Money. And they talk about this idea that people usually fit into one of 2 categories. You get people that don't know how to make enough money, and then people that can't stop making money. And it was interesting because when I sort of reflected on the people that I know and I look at in the rest of the world, I can see a lot of people fitting into that category.
Which one?
So either people are stuck in an idea of they need to continually make more money, or they can't stop making money. They don't have an end goal in mind to define where they want to be in life. And I thought that was an interesting, I don't know if this comes with maybe age as well. I think if somebody had asked me that question when I was your age, I would think that the end goal was just an endless pit of money that I wanted to be in as well.
Oh yeah, no, it's not about the money. It's not about the money, because right now I'm living very comfortably, and it's not that after a certain point, I think, I mean, I'm not saying from my experience, but from the experience that of the people that I talk with, that I interact with, there's no big difference to your day-to-day lifestyle. So yeah, I'm not doing it for the life. Maybe I started it for the lifestyle. Maybe everybody started it for the lifestyle these
probably.
years. Yeah, but no, I'm not thinking on money like anymore.
Okay.
Yeah, I just love the job, and I want to keep doing it, and better and better. Yeah.
Fair enough. Fair enough. One of the final few topics I want to bring up, because I feel like you're going to have a really good opinion on this, is the topic of mentors, right? So this is something that you've brought up yourself a few times today, and something that we obviously touched on before we jumped into the studio about how there are not enough people have a mentor these days, or maybe there's not enough importance on finding the right mentor. What was that journey like for you? Why do you think everyone needs a mentor, and how would you advise people to actually find the right one?
Okay, so interesting question. Especially the second one is very good question. So, okay, obviously it's not that there are not enough mentors in the world. It's probably that people don't know how to approach them, because the average person that wants to learn trading finds probably a mentorship or whatever, paid mentorship, wants to pay for the information, and then complains if the information is too expensive. Okay, but if you only have to offer money and you want the best of the best, probably what you pay will be measured with money. Okay, so technically, in a fair world, the more you pay, the more quality of information you will get.
Yeah.
Okay, but for that reason, many good mentors, especially people that worked in an institution at an institutional level, they don't have mentorships. Most of them, So why would they take you as a mentee with them? Of course, you need to have something to offer to them. So, for example, I hadn't had a real mentor, stable mentor in my life up until a few months ago, and I always said my mentor was my mistakes and the markets and my hard head that I hit on the wall so many times. Okay, that's a good starting point. Okay, but I can clearly see the difference between before having my current mentor and right now, because some things you just can't work out by yourself. And I don't pay my mentor. Okay. I don't pay him money. He still teaches for money to some people, but he doesn't give the level of attention to them that he gives to me. We basically live together. Why is that? Because we are building something together. We are doing research together. And we met very randomly. We had a conversation, and it all started from a conversation. It wasn't that I reached out to. I didn't even know he was a good financial analyst. I didn't know up until speaking to him. So, of course, it's hard to find good mentors because you don't have anything to offer to them. And if you have something to offer to them, which is money, it's not worth for the mentor to follow you through the whole day, every day. Why? Because otherwise, it's impossible, of course.
Yeah.
If let's say I'm teaching to 100 people, okay, and I'm taking, 500 a month from each one of the persons. Okay. Yeah. How can I follow them to my best ability every day through the whole day, every one of them, without sacrificing my job and doing it properly? It's impossible. So, of course, that's as far as money can take you. But I'm not saying that's bad. That's, of course, a good starting point. Also, I have to mention, I've done a lot of mentorships. I've bought a lot of courses. I've educated myself on this topic a lot. And not necessarily, actually not at all these mentorships and courses were beneficial directly to me. So from most courses, I learned, the thing that I learned was what not to do.
Yeah.
Or something about the approach.
Yeah.
Or maybe the phrasing of a certain sentence drew my attention to a certain detail that I was working on, and then I started doing research on that. So I'm not saying it's not worth it, because that's how I built myself up. So I can't say it's not worth it. But You just have to have the correct expectation. So right now I'm actually learning more from mentorships and courses than before. Even those that I wouldn't even consider. PDFs of people that actually don't have any type of track record of profitability, whatever. Why? Because I'm very quick to filter what can be useful, what's definitely not useful, and what's very useful. Right now I'm very used to it. So it's not even that the coach that you're paying has to say something specific that's very true or that's very profitable or whatever. It's about you filtering what he says and understanding, because at some point every mentor, even if it's unprofitable, has learned something from a person that's actually profitable through a chain, not directly, maybe indirectly. So you will find something about Chris Laurie in some kid that's now selling a course that's not even profitable. Something, okay, and that will remind you probably to important topics that can lead you to profitability, or that can lead you to doing your research on the right thing. So I always advise people to keep learning, even if the source is not reliable. That doesn't really matter. That's not the point of this kind of learning.
I like that outlook a lot, because I'm a big, even before I came into the coaching side of anything, because I started off as a life coach before it was coaching traders. I was really big on personal development, and the biggest part of personal development and growing as a person is having that growth mindset. And that's understanding that there are things to learn from every situation. And I think there are a lot of people that operate in life, in the markets, that have a very closed-minded and pessimistic outlook, right? And the way I always heard it best is you can take two people. One's an optimist and sees opportunities and growth in everything, and one is a pessimist and sees negativity and hate in everything. And you can send them into the same room with the same group of people, and they will come out having two completely different experiences. And it's not the people, it's not the situation, it's not the experience that they had which is bad, but it's your perception of that and what you choose to take away from that. So when you talk about taking courses or mentorships or PDFs or whatever it is that you take, even if there's stuff in there that you think doesn't work or is complete rubbish, if you can eliminate something to say that this is not going to work for me and therefore I shouldn't spend any more time on this, I actually think that could be a positive experience, and it's something that you could learn and grow from as a person. The biggest thing that I've taken away, because when I share with people that I started trading in 2012, people look at me like I'm a dinosaur, or I've been around a long time, or I must know it all. And I tell people the same thing, like, till this day, and I think this will forever be the case, I'm a student of the markets. I'm continually learning. I'm continually trying to have conversations where I'm picking up something new. I'm never feeling like, oh, this person's only traded 6 months, there's nothing to learn from them. They may have seen or experienced something which I can take some value in. And I think unless you're open-minded enough to have those conversations or be open to those experiences, it's very, very difficult to just continue to grow in life. And I think especially as a trader, the markets continually evolve, right? They continually change. And unless you have an ability to grow and adapt with them, at some point, you're probably going to get left behind. So
it's very true. It's very true.
Yeah, it makes a lot of sense to me. I want to kind of wind things down, and I want to ask you a few questions.
Okay.
So one of them is a little bit psychology related, and I'm pretty sure I mentioned this on our last episode. I took this exercise from somebody online, and they phrased it in a way which was fantastic. And I use this with a lot of my clients, and it gets them thinking a lot about mindset and the person that you need to be in order to be a successful, consistently profitable trader. So the exercise is this. You are brought you're in a position where you're managing a hedge fund or a prop firm or something, which is probably likely in your future, given by the path that you're currently taking, right? Your job is hiring new traders to be on your desk. However, the traders that come in for an interview, you don't have any track record from them. You can't prove they are profitable through any means of a track record.
Okay.
What characteristics are you looking for in that person to determine whether they would be a good trader or not?
Okay. First of all, if I'm ever in that position, I don't need to see they are profitable.
Okay, I like this.
Because I don't even need a track record. I just need them to show me the last trades, and I already know if they're positioned or not.
So if you can't see their trading record at all,
Okay.
what do you
Oh,
look for in a person, in the mindset, in their approach?
Character-wise,
Yes.
they have to be stubborn.
Okay, I like that.
Otherwise, how can you? This is a shark's world. Like, trading is the ultimate competitive business, even if indirectly, because it's player versus player. And yeah, you have to have that kind of mindset, which is like my mindset. And that's the one thing that every successful businessman that I meet these days have in common, is they are stubborn. Yeah, not in a bad way, like in a good way, you know. Another characteristic, you have to be, okay, this is kind of an peculiar point. So you have to have your ego, but also be humble. What do I mean? You have to have your ego, so know your worth business-wise, like in this case trading-wise, but know when to put it down and be humble. So in a conversation, come with your ego, come speaking to me, okay, like I will speak to you about my experience, you will speak to me about your experience. But if you are inexperienced and you figure that out during a conversation with another person, you have to know when it's time to step down and go in sponge mode and absorb everything you can. That's a key characteristic you have to have. I did that with my current mentor. I stepped in the first conversation with him, very, not cocky, but I wanted to show him that I know what I'm talking about, and I wanted to show him what I know that I'm talking about. But then when I figured that he knows, like the level of my knowledge was a grain compared to his, I just shut up.
Yeah.
I had 2 years for this reason, so I shut my mouth and I started listening to him. That's a key characteristic in business in general. And these are two. I think it's
good with those.
Yeah, so far, yeah.
Okay, cool. I like that. I like the. I think the stubborn one took me off guard, but I think the way that you described it makes a lot of sense. It can be quite beneficial. I like that. Okay, if you could change one thing about the trading industry today, whether it was to do with social media, whether it's the online gurus, whether it's something about how the maybe education system is in trading at the moment, what would you change and why?
I would reintroduce the common knowledge about the true aspiration of a trader. So reintroduce the fact that a trader is, first of all, his end goal should be to manage big capitals that probably won't be his own, because unless you have a family office, because you have a very wealthy family, that will not be the case, and those are very rare. So yeah, just reintroduce the concept of a real trader. So a trader is a person that manages big capital and most likely won't be his.
Nice. I like it.
Yeah.
Final question for you before we wrap up. If you could go back, and I'm going to say this lightly because I'm going to say your younger self is probably not that many years ago.
Yeah, it's not.
If you could go back to the starting days of when you started trading, because I know you said you've had a lot of recent breakthroughs since obviously meeting your mentor. What advice would you give yourself that you think would be beneficial to somebody else in their early days that they could take from this?
This one I'm not quite sure about. You know why? Because everything, I've had a rough time. Like I had some months, some experiences that are very bad in terms of performance. But I think that the fact that they were so bad accelerated my learning curve so much. So obviously I can't advise people to lose money, because that's also an interesting part. Is when I talk to different people, different traders that are successful, everybody has a different story. Everybody trades in a different way. Everybody has been brought up in a different way. So I can't really give advice on that. I can say everything that I've done, every mistake that I've done, doesn't matter how big or small, has accelerated my learning curve. And the big mistakes were more beneficial than the small mistakes. I can say that.
I like
Then
that.
people can interpret it how they want.
Yeah. I like that. I like that. I think that's a nice message to end things off for everyone tuning in. Pietro, thank you so much for tuning in today.
Thank you.
And flying in to be with us today, man. Really appreciate it.
My pleasure.
Thank you so much. Guys, thank you so much for tuning in to another episode. I hope you found some massive amounts of value from Pietro. Before we wrap up, actually, where's the best place for people to come and find you if they've enjoyed listening to hearing you speak today?
Right now, Instagram, where I'll be more active probably from today on. And I also have a Twitter. But yeah, there so far. And if I ever open a YouTube, it will be said on Instagram. So
all right. Yeah. Perfect. There you go. You have it from the man himself. Thank you guys so much. If you enjoyed this episode, it would mean a lot if you comment below and take away your biggest message. Share that with us so that we know what you've taken away from today. Till next time, my friends, take care.